Difference between trading and investing. There are a lot of words used to talk about money, financial planning, and financial health. Some of these words are used correctly, while others are used incorrectly or interchangeably, even though they mean very different things. So let's take a closer look at two common words that are sometimes used as if they mean the same thing, even though they don't. Let's start with trading. Trading is all about making frequent short-term purchases and sales with the goal of beating the market or making more money than you would if you bought and held for a long period of time. Long-term investors might try to get a 7% return every year, but a trader might aim for a 5% gain every month. In trading, short-term can mean anything from a transaction that happens right away, like buying and selling a stock within minutes, to a transaction that lasts weeks or months. Traders buy and sell stocks, commodities, the foreign exchange market or forex, and other securities that can be bought and sold quickly. The time between when you buy a security and when you sell it is called a holding period. Buy low, sell high is a phrase that is often used in trading. Traders try to make money quickly by keeping a close eye on how prices change. Technical analysis is often used by active traders to look at stocks and predict trends in how their prices change. This means paying more attention to a stock's technical factors compared to the company's long-term profit potential or large-scale changes in the economy. Another strategy that traders often use is called short selling, which is opposite of the phrase we just talked about. When short selling a stock, traders try to sell shares they have borrowed at a high price and then buy them back later at a lower price, making a profit from the difference in prices. Traders often use limit orders and stop orders to set the price at which they buy or sell stocks. For example, a trader can use a limit order to make sure that a stock won't be bought or sold until the price reaches a certain point or higher. With a sell stop order, a stock can be sold if its price drops to a certain level below the current price. With a stop loss order, a security will be sold if the price falls below a certain amount and stays above another amount. Traders have more control over the price and time of their trades when they use these types of orders. On the other side of the spectrum, investing is a way to manage and grow your money in the market over a longer period of time, often spanning over several years or even decades. This means buying securities with a long-term view and keeping them through market ups and downs until you reach your financial goal or are close to the end of your investment time horizon. Many people save for retirement by putting money into the stock market with an RIA, individual retirement account, or 401k account. With these types of accounts, you might not check your account every day or even every month, or make changes to the securities you own. Instead, you'll probably commit to them over a long period of time, making an investment that could pay off. You could also put money into a personal investment account, such as through a robo-advisor or self-directed trading, also called DIY trading, to build your own wealth or save for something like buying a house or going on a trip around the world. When it comes to investing, having patience can be a good thing. Successful investment strategies usually take a long time to work out, and as an investor, you may have to wait a long time to get the best possible returns. But the longer you leave your money on the market, the more chances you have to make money from compound interest or returns. Think about it this way. If you invest $1,000 and earn an average of 7% per year, you'll have a $1,070 after a year, which is a $70 gain. In 2 years, it will be worth about $1,145, which is a $75 gain. If you leave your money on the market for a third year and get the same 7% return, you'll have $1,225, which is $225 more than when you started. Compounding lets your gains grow year after year without you having to add to your initial capital. Remember that annual returns change, and there is no guarantee that you will make money every year. Due to the volatility of the market, you may get a 7% return one year, but you could very well get a loss the next year. It's important to know that there's always a chance you could lose money when you invest. With patience comes the determination to stick with your investments, even when the market is unstable. When bad news hits the fan, you may be tempted to sell your securities. However, making investment decisions based on your feelings can hurt your portfolio in the long run. By not investing based on how you feel and keeping an eye on the long term, you can ride out short-term ups and downs and possibly take advantage of the market's long-term trend of going up. Diversification is one of the best ways to keep you cool when investing and set up your portfolio for success in the future. A diversified portfolio is made up of investments in different asset classes, industries, and countries so that you can keep your risk level at a level you're comfortable with. Spreading out your investments makes sure that you don't depend too much on one part of the market. There are many ways in which trading and investing are different. The most important difference between investing and trading is the way each is approached. When investing, the investor looks at a company's fundamentals. When trading, the investor looks at the company's technicals. Fundamental analysis looks at the company's finances, its past financial records, the industry the company is a part of, and the industry's overall performance based on the country's macroeconomic situation and the results. Technical analysis is the study of daily financial trends, such as how well a company is doing based on the ups and downs of the market. The traders have to pay close attention to the company every day because it makes financial decisions that show up in the charts and numbers on the stock market. This information helps traders make accurate predictions about how things will change. They do this by looking at trends in volume, price, and moving averages. Traders have to be flexible and buy or sell based on what's going on at the time. Investors, on the other hand, study the company closely, invest in it, and hold it for a longer time so that they can make money with less risk. Most of the money that is invested in trading is in working capital, while most of the money that is invested in investing is in fixed capital. In trading, all of the capital is put into goods that will be sold again, so there is a risk that the prices of the goods will go down before they are sold. In investing, fixed capital has less risk, and only the return on it has a higher risk. The time between when you buy something and when you sell it is called the trading cycle. A trading cycle is usually short, and there are many reinvestment or trading cycles in an accounting period. All of the investment in the trading cycle is paid back when the goods are sold and the money is put back into the business. When it comes to investing, money can be put away for a long time, over more than one accounting period, to get returns on a regular basis. There is no need to replace the investment until it needs to be taken out to be used for something else. Trading has more risk, but it can also give you more money in the form of profits, because all the money you put into it either goes up or down in value. Most of the time, investing is less risky and gives lower returns relatively. When you invest, the amount of capital you put in does not change in value, except for the effects of inflation. The only thing that can change is the return of it, if it has a variable rate of return. In trading, the investor has to be more involved in the buying and selling, but once an investment has been made, the investor doesn't have to do anything else. The trader's ability to manage the downside risk may affect how much money can be made, since better negotiating when buying and better pricing decisions when selling can both lead to higher margins, which puts more money in your pocket. After an investment has been made, it does not need to be managed. Investing and trading are different in how they are done, how much risk they involve, and how much time they take. It's fine to do both, and the person's choice will depend on how willing they are to take risks and how long they can wait. Investing is for the long term and has less risk than trading, which is for the short term and has a lot of risk. Both traders and investors can make money, but traders have the potential to make more money when they make the right decisions, especially when they are trading with leverage. Regardless of whether you pick investing or trading, it can serve as a fantastic way to make your money work for you. However, you need to make sure you avoid this deadly mistake that can hinder much of your progress. Check out this video right here.